Most financial advice you hear online today sounds really smart. It sounds optimized. It sounds sophisticated. And if you're on TikTok or YouTube and you're scrolling around for more than 5 minutes, you probably heard this one. Do not pay off your mortgage early. Invest the money instead. And this is something I talk about all the time as a longtime 25-plus year real estate agent. And this is what they want to tell you, right? If your mortgage rate, which current rates are hovering around 6%, or for many of you, just like myself, maybe you have a rate like I do at 2.875 or in the threes, and the stock market returns over the long haul 8 to 10%, they want you to just invest the difference, right? Keep that loan on your house and invest the difference. So the math sounds great. And it's also how a lot of normal people end up carrying debt for 30 years while their quote unquote investments go through 2 or 3 market crashes or a job loss or a divorce or any of the other dozen things that a spreadsheet does not account for. And I'm a spreadsheet nerd and I love looking at the numbers, and it just seems like it makes sense. Borrow for 3 or 4%. Earn 8 or 10%. Makes total sense, right? Well, today what I want to do is I want to tell you why paying off your mortgage early is not just a safe play, but it could be one of the most powerful wealth building moves you can ever make. And I'm going to show you exactly how you should do it or who should not do it. So now, before you think this is just another opinion, let me tell you exactly where I'm coming from. My name is Brian Lessinger, and I have an MBA, a degree in finance and economics, and I personally spent over 25 years working in finance and real estate. And I've personally bought and sold way too many homes to count, and I've carried mortgages, and I've had some mortgages that I paid off, and I've watched what happens when the market does not cooperate with what your spreadsheet says. And again, whether it's commercial, residential, it doesn't matter, okay? In 2008, I was personally $750,000 in the hole during the Great Recession. And I've seen the other side, the dark side, the bad side of what happens when you are over-leveraged and you are leveraged to the gills and the economy turns on you in an instant. And so when I tell you debt freedom has a huge amount of value and it doesn't always show up in the calculator, I'm not speaking theoretically. I personally lived it, and I've watched so many of my clients over the years, many of them who lost many homes back in 06, 7, 8, 9, and 10, because they did this. They went over leverage and mortgaged themselves to the hilt. So here's the argument you've probably heard 1,000 times. I hear it all the time, is that let's say you have a mortgage at 6%, which right now might actually be pretty high because many of you, like myself, have them really lows in the 3 and 4%, right? And the stock market historically is going to earn you 8, 10, even more percent, okay? So instead of paying extra on your mortgage, you take that money and you invest it. And on paper, you come out ahead by 2% or 4% or maybe even more. And it sounds super simple, right? Except here's what 25 years in finance has taught me is this. People do not behave like spreadsheets, okay? This invest the different strategy requires you to do every single one of these things perfectly for 20, 30, or even more years. And you have to be consistently investing every single month for decades and decades. And this is where I have people struggle, where if I can get young people in their 20s to do this investing every month for decades and decades, they would be multimillionaires without question. But what you can't do is panic sell when the market drops 30%. And trust me, there are times it will drop 30%. And I promise you, you can't let lifestyle creep eat at your money. You also cannot tap into this early for money for a car or money for a vacation or dipping in that money for an emergency. And you cannot stop contributing when you change jobs or you take a pay cut. And what you don't want to do is touch it during a divorce or a medical crisis or any of the other things that real life throws at you. And this is going to happen over 20 or 30 or 40 years, right? So let's be honest with yourself for a second right now. How many people do you know that have gone and done this perfectly for 30 years? I've been in this for 25 plus years, and I can count on one hand how many people have done this perfectly over time. But if you pay off your mortgage and if you get that done, that is a guaranteed return. And for many that might have a 5, 6, even 7%, that is automatic. You've made that money, right? You've offset this interest you were going to pay to someone else, and it's done and it's over. And no market crash can take it away, not a bad quarter of income or a bad quarter of spending or no panic selling your stocks. It is a permanent, you have won at this game of money and finance because you own your home free and clear. So let me explain what happens when your house is paid off, because most people have never experienced this and they don't fully understand what position this puts you in when your mortgage is gone, okay? You've eliminated, for most of you, your single largest monthly expense. Let me say that again. When your mortgage is gone, you've eliminated your single largest monthly expense. And for most households, that can be anywhere from on the low side, $1,500, on the high side to $3,000 or even $4,000 or $5,000 a month. And it is gone permanently forever. And I realize, yes, you're still going to have maintenance on a house, and yes, you're going to still have insurance and property taxes, but you're still going to have rent if you didn't have that stuff anyway, or you're still going to have that payment every month. So now think about what this means for a minute in your real life, okay? Let's say you lost your job and you're not scrambling to have to make that mortgage payment. Or let's say you want to start a business, or let's say your business is just struggling for a while. Your risk profile changes when you don't have that $2,500 or even more a month house payment hanging over your head. Let's say you wanted to retire early. Your number just dropped dramatically because you don't have that house payment. All you're having to worry about and deal with is potentially some repairs and some expenses, some property taxes. And here's the thing about the spreadsheet crowd that they never talk about, okay? The sequence of these returns risk. Let me put my finance hat on for a minute. Let me talk about something else, okay? If you are carrying a mortgage and the market, let's say, underperforms for a decade, which of course recently hasn't been the case, but there have been times where for a full decade, the market didn't perform very well, and it does happen, you're getting hit from both sides. And what does that mean? Your investments have been flattered down, your interest payments are still going out the door every single month, and now you're bleeding on both ends. But if your house is paid off, you're immune to that. The market can do whatever it wants, but you still have a roof over your head and you have no house payment. And that's just not math. That's the financial shield that nobody can talk about or nobody can take from you, okay? So I've watched so many people who've gotten over leveraged, and I did short sales and foreclosures and watched all kinds of horrible financial things happen to people. But if your personal homes and your rental property are paid off, you're in a great spot. I watched so many over leveraged people lose everything back in the Great Recession with personal homes that they had, with rental property that they over leveraged, and they lost everything. But if you own all of this stuff, then you don't have to worry about things. And here's what happened. By the time all of that had ended back in the day, I was $750,000 in debt because business and finance just stopped during the worst financial crisis in modern history. And I will never put myself in that position again. And so I'm a little more conservative than most, and I will never put myself in that position again. And I don't think you should either. So just be cautious when you see all this content online about using leverage and over leveraging yourself. Just be careful with all that stuff, okay? And this is the part where it really gets exciting, okay? This is the part that the invest instead crowd completely misses. Once the mortgage is gone, that payment does not disappear into thin air. It becomes fuel. And what do I mean by that? Let's say your mortgage payment was $2,500 a month. That is $30,000 a year that you now can redirect. So imagine if you took that $30,000 a year and you invested it every single year. You just kept making that payment to yourself now rather than making that payment to the bank, right? This is what I now call the secondary acceleration phase of your saving and investing plan, right? You spent years paying down the house. And now that money that was going to do that was going to the bank, that was paying off your interest and principal, you can now use to build wealth. And here's the beautiful part. You're now investing from a position of total security, right? You have no debt. You have no pressure. Most of your fear has gone away. And now you can play pure offense. $30,000 a year invested at even a conservative 7% return. In 10 years, that's over $400,000. In 15 years, now you're pushing $750,000. And you did it with zero housing risk because you already have a place to live so that making that mortgage payment isn't hanging over your head the whole entire time. And if you think this is a bad strategy, explain that to me. So you can do this and still win at the game of money and finance, even if it feels like a more conservative way to go. So this is that one more piece that nobody talks about. And honestly, after 25 years in finance, I think this might be one of the most important pieces that people don't understand. And it's what happens in your head, between your ears, when you own your home free and clear, okay? People who pay off their mortgages and pay off their homes tend to save more aggressively after the fact because they don't have that risk, hanging over their heads. You start to take smarter risks. You stay invested longer during downturns because there's not this panic about making their mortgage payment or losing their job. And they avoid lifestyle inflation because they've already proven to themselves they can be disciplined. They can save and invest. They can pay off their mortgage. They typically sleep better. And I know this is going to sound overly simplified, but here's the thing, and I'm telling you, the stress of debt affects every financial decision you make. And when you remove debt and you don't have any debt and you're starting to be able to make better decisions across the board, this is the thing the spreadsheet can never capture. It's that behavioral shift, that feeling inside that comes from knowing nobody can take your home away from you. And it's not just this great feeling, it's a huge financial advantage, okay? Now, I'm not going to sit here and tell you that everyone should pay off their mortgage early. That wouldn't be honest. And personal finance is very personal. So what I want to do is I want to break down who this is really for. Who might be better off taking a different approach and maybe not paying off your mortgage early? But to me, paying off your mortgage early makes sense if you're a middle-class household that's trying to build real wealth, lasting security. honestly, you're not going to invest consistently over 30 years without touching the money. You're the kind of person that almost is better off being house poor because that saving and investing happens and you're forced into doing it. Maybe you're an entrepreneur, you have variable income, and the idea of a guaranteed reduction is more valuable to you than a potential market return. So let's say you're within 10 or 15 years of retirement and you want to walk into that chapter debt-free. Or maybe you've been through a financial crisis just like me, and you never want to have that feeling again of not being able to make that house payment or feeling you're not going to be able to do it. So I'm going to raise my hand on that one. That is one of the reasons why I want to have my mortgage debt-free and have all this stuff gone for myself. So if investing may make more sense for you than paying off a mortgage, if you are maybe a high earner or someone who has surplus cash flows and you're already maxing out your retirement accounts, or maybe you are one of those people who does genuinely have the discipline to invest consistently for decades without ever flinching. Maybe you're someone whose mortgage rate is locked in at 3% or lower, and you're just like, I'm going to keep doing what I'm doing because that 3% rate is so low that I will keep doing what I'm doing. Or maybe you're someone who's just comfortable with volatility. And maybe you have a long time horizon with no major life changes on the horizon. So you might be a young person that just says, I'm not going to worry about getting that paid off yet. And that's okay too. Maybe you notice how much smaller that second list of people is going to be. And maybe you notice how much self-awareness it requires to actually say, I am going to have the self-discipline over these next 20 or 30 years to keep my mortgage and keep making that payment and investing the difference. So now, which list do you want to be on? Think about your behaviors over the last 5 years and ask yourself the questions, am I someone who can handle the volatility and someone who's going to be consistently investing? Or I'm someone that I might panic a little bit when things go good or bad? I just think paying off your house is a good way to go. So why does almost every finance creator online tell you the opposite of what I just said? And here's a few reasons. The optimization culture, right? The internet rewards the most clever sounding answers and not the most practical ones because they think everybody can maximize every nickel and try to invest and make money and just maximize everything. Telling someone to pay off their mortgage, it just sounds boring, right? It sounds too conservative. But telling someone to leverage cheap debt and invest the spread sounds sophisticated, right? It will get clicks. And the other results is just for normal people, right? But here's the second thing. A lot of the advice is designed for people who already have money, right? So if you're someone who makes $300,000 a year, you have $200,000 in savings, and maybe you have a 3% mortgage, investing the difference probably makes sense for you. But that is not most people, right? Most people who I interact with are making somewhere between $60,000 and $100,000. They're carrying a mortgage and they can barely afford, or they're living paycheck to paycheck. And being told to invest the difference or not paying down their mortgage just does not make any sense, right? The advice that they're getting just doesn't translate. Third, the financial industry benefits when people have money invested. This is how advisors get paid. This is how platforms make money. This is how assets under management, this is their business model. They make more money when you have more money invested. And nobody makes commissions when you send an extra $500,000 to your mortgage company, right? Where you're just paying off your debt. So I'm not saying this is a conspiracy. I'm not saying follow the incentives. I'm just saying be careful with the advice that you're watching online. And lastly, here's the thing. Debt has been way too normalized, right? Somewhere along the line, we decided a 30-year mortgage is just part of life and everybody should have one and you should take 30 years to pay it off. And here's what I think. I think the most sophisticated financial move for most people that they can make is to eliminate their biggest liability as fast as possible. And then you can go on offense. So I always tell people, if you can get your living arrangements, whether you are a renter, whether you are someone who has a mortgage, if you can get that biggest piece of your finances that go out every month taken care of, it allows you to be able to go on offense super quickly and aggressively. So let me leave you with this. You do not need to build wealth by optimizing spreadsheets. You build wealth by removing the biggest risk from your life, the biggest financial risk from your life. And for most Americans, their mortgage is the single biggest financial risk they carry. Maybe you're someone like us and you have a business loans and business leases and other things that can also be part of your risk. But for most of you that have a job, they get paid every 2 weeks, that mortgage is your biggest risk, right? And every month that payment comes due. So regardless of what the economy is doing, regardless of whether you still have a job or not, a paid off home changes so much mentally between your ears. It changes your risk profile. It changes your options. It changes your behavior. And it changes how every future financial decision you make, how it will feel. Take it from me. Again, I was $750,000 in debt during the most awful financial crisis that most of us, at least my age and younger, will ever see. And I know what that pressure feels like when your chest hurts, when you can't sleep at night. And debt freedom is not just a number on a spreadsheet. It's a completely different way of moving through life. And if this makes sense to you, here's what I want you to do. Subscribe to the channel. I put out videos every week breaking down money decisions that actually matter. Not the ones that sound clever at a dinner party, the ones that can actually change your life. Now, I want to hear from you. Are you on team pay off your mortgage, or are you on team invest the difference? Here's what I want you to do. Drop a comment below and tell me why. And if you want to go deeper on real estate, watch this video I did right here where I break down the simple math of residential real estate investing, down payments, loan types, how to get your first property. So I'll see you right there.